What is going on, traders? So the Silicon Valley Bank situation is changing by the minute. I didn't have time to make a fancy video and I needed to make a video update on yesterday's video, but I did a whole explanation on why SVB suffered a bank run and why Signature Bank now, which is another bank that suffered a bank run over the weekend since I did that video, why they suffered bank runs. What does the Fed have to do with this? How does the Fed policy of aggressively raising rates actually have to do with the bank runs? But it wasn't all of the Fed's fault. Obviously, there was some mismanagement of risk as it related to SVB. And again, I explained it all in the video, so go back and watch that video. But here is the video update. What is going to happen to depositors? What is going to happen to SVB assets? Are depositors going to get their money? More importantly, who's going to front the bill? Is this considered a bailout or not? So let's just get right into it. So what happened with SVB? First off, HSBC put in a bid for SVB's UK arm. So there was some speculation that HSBC was going to be buying SVB entirely. That's not true. They're only buying the UK arm of assets. So what happens with the rest of it? Well, the rest of it is put into receivership, just like Washington Mutual was in 2008. Which means that it is now up for sale. And I assume within the next couple of weeks, we will hear of a larger bank swallowing up these assets for pennies on the dollar. Now, is this a bailout? What happens to depositors? Here's what happened. So some are, I think, incorrectly calling this a bailout, including someone who's running for president named Vivek Ramaswamy. I believe that's how you say his last name. He's really banging the drum on this being a bailout. Is it really a bailout? Well, let's see. What is a bailout? A bailout is when the money actually comes from the taxpayers or the government. A bailout a la 2008 is when shareholders as well as executives get bailed out. None of that supposedly is happening here. So executives aren't getting bailed out. Shareholders aren't getting bailed out. The bank actually was allowed to fail. The bank has failed. It's shut down. It's closed. The bank does not operate anymore. It doesn't have operations. It will cease to exist. So when the Treasury, the Federal Reserve, as well as the FDIC, which is the Federal Deposit Insurance Company, again, I went over who the FDIC was in my previous video. So watch that video for more detail on that. But basically, all three of those entities came in and did a joint statement yesterday over the weekend on Sunday saying that all depositors' money is going to be safe. Depositors are not going to lose a dollar of their money. More importantly, taxpayers are not going to suffer even a dollar of the burden for bailing out. In this case, I'm using it incorrectly, but for bailing out the depositors of SVB. So where is the money going to come from? Well, a couple of places. The FDIC, which is the Federal Deposit Insurance Company, the limit of their insurance is $250,000. That means if you had $100 million in the bank, generally only $250,000 of it is insured, even if you are a business. And SVB had over 40,000 accounts, most of which are businesses, most of which were over 250,000. So obviously the regular FDIC insurance is not going to cover the depositor's money. So where is that money coming from? Again, two places. One, the FDIC said that they are going to be giving advances to depositors. Now, where are these advances coming from? Are they coming from the taxpayer? Well, according to the FDIC, no. They are basically coming from future sales of SVB assets. So the FDIC shut down SVB, and obviously they're putting up their assets for sale at the moment. Again, as I said, the UK, HSBC bought the UK arm of SVB. The rest of the assets are up for sale. So they gave the depositors an advance for after a sale of the bank's assets is completed. That is where the money will come from. They just paid the depositors in advance using FDIC money. And the FDIC has over 120 billion on its balance sheet. And secondly, the Fed said that they're going to step in, and they created a new program out of thin air, but they said that they're going to step in and give banks and depositors a loan and relax their terms for these loans in case any backstops are needed. So I don't think that the Fed is actually using that backstop for this. I think that the FDIC so far, at least for these two bank runs, SVB and Signature Bank, that the FDIC's advance payments are going to cover depositors in this case. So I do agree that the Fed, the Treasury, and the FDIC needed to act swiftly, because what they're trying to do is really prevent future bank runs, because bank runs are actually very easy to organize if there's enough panic. Bank runs, again, as I stated in that video, is more about psychology than it is about liquidity. If everybody panics and rushes to the bank to pull their money out at once, well, if that happens at a large enough scale, no bank in the US or in the world for that matter is safe, right? So what they're trying to do, these entities, is trying to hopefully prevent future bank runs. So I do think that they were right to act swiftly. And so far, if we believe them, according to their statements, this does not seem like a traditional bailout, regardless of what Vivek says or others in his camp say. This does seem like something entirely different. Now, we've also seen things like this where later down the road, somehow, some way, shareholders and executives end up getting paid. So for me, as long as what is stated is true, meaning this isn't coming from the taxpayers' money, it's just coming from an advance of future sales of SVB assets and Signature Bank's assets, I'm okay with that, right? Because FDIC, none of that comes from taxpayer money. That comes from other banks' monies. So the FDIC, how they have money on their balance sheet is basically banks pay a premium to FDIC the same way that you pay a premium to your car insurance company or home insurance company, right? And banks are required to pay this premium. And so the FDIC actually has a balance sheet of assets made mostly from other banks paying them this premium. So as long as it's not coming from taxpayer money, and as long as shareholders and executives aren't paid out, so the company is bust, SVB no longer exists, and all that we're taking care of is the depositors, and the depositors are being taken care of from future sales of SVB's assets, I'm personally okay with it. So let's see how this story unfolds. Let me know in the comment section, do you agree with this? Do you think it's a bailout? If you disagree with me and you do think it's a bailout, let me know why. I would love to hear from you. If I got anything incorrectly, I would love to hear from you as well. So leave it in the comment section below. Again, subscribe to the channel, hit that notification bell. Remember that March 14th at 8:30 a.m. Eastern. So tomorrow, from the time of this recording, we're going to be going live for CPI. You don't want to miss it. So join us live for CPI. We're going to be covering the market's reaction live as well as trading live. But let me know in the comment section whether you agree with this, whether you think it's a bailout, and what ramifications do you think it's going to have on the banking industry? Is it going to stop future bank runs? Is it going to be enough? Was this much ado about nothing? Is this where the bank runs stop? Let me know what you guys think. Curious to hear your opinions. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.